On the mortgage real estate market, a lot of people think of REITs and they think of public equity REITs, right? Where you own a building and you get the rental income off the building. But almost all of those buildings have some kind of mortgage debt on those. And the mortgage REITs that we invest in they provide the first lien mortgages to real estate. Now, there are lots of subcategories in the mortgage REITs. We have commercial mortgage REITs, we have agency mortgage REITs, hybrid residential credit mortgage REITs. And those all have different factors, and maybe we can get into that if you want to during the Q&A, but it allows us to kind of play different risks and different options within the mortgage REIT market. But if you look again through the statistics of what we have exposure to in the Littman Gregory Fund, over $17 billion of commercial mortgages and over 500 individual commercial mortgage loans. Over 1 million residential mortgages with $150 billion of residential mortgage exposure. And our portfolio today is about 50% floating rate, 50% fixed rate. Again, on valuation, the mortgage REITs are getting close to book value, a little bit of a premium to where they have been historically, but they're generating significant income right now. So the average dividend yield on our mortgage REIT market is 10%, and they're covering that dividend about 110%. So we feel very confident in the dividend coverage there. And what's interesting, when people think about REIT exposure and, again, passive flows into REITs, they're not flowing into the mortgage REIT market. So when S&P created the real estate subcategory a couple of years ago, they actually excluded the mortgage REITs from that. So again, this group, again, is not getting a lot of the institutional flows that happen particularly with the passive flows that we're seeing.
We didn't really talk much about mortgage REITs. Could you, maybe for people that aren't as familiar with the space, go into the differences between the agency, the hybrid, and the commercial, and why you might favor one versus another in those subsectors?
Yeah, so they're actually they move very differently. So commercial mortgage REITs are exactly what you would think if you've got a commercial property. Let's say somebody owns an office building here in San Francisco, and maybe they're at 75% occupancy, but they know if they put in $50 million into the building, improve the lobby, improve the office space, they can drive that occupancy up to 95%. What they'll do is they'll look to the commercial mortgage REITs to make a 3 to 4 year loan that helps them with that capital to lease up the building. And so that's what the commercial mortgage REITs do, is they're typically 3 to 4 year loans. They're floating rate, typically with an interest rate of LIBOR plus 350, and they're all first lien mortgages. So when we look at the commercial mortgage REIT space, they typically on their balance sheet will use 2.5 to 3.5 times leverage on their balance sheet. And they generate kind of an 8 to 9% dividend yield, and it's steady, consistent. Average loan to values is 65% in their portfolios. And we feel really confident about the cash flows and the dividends from those portfolios. The agency REITs are almost the exact opposite. So what agency REITs do is they buy a portfolio of residential Fannie, Freddie, Ginnie Mae, government-backed 15 and 30-year bonds. And then what they do is they borrow on 1 month and 3 month repo, and they're just trying to make a spread between the long end of the yield curve and the short end of the yield curve. And in our view, that's a model that sometimes you want to be in and sometimes you don't. And actually, from 2006 to 2008, the first 3 years we were investing in this strategy, we owned zero agency mortgage REITs. Because the Fed was raising interest rates, they were unwinding their MBS portfolio. That's going to do two things. It's going to negatively impact the value of the long bonds, so you got book value going down, and it's increasing the short-term interest rates that they're borrowing at, so you've got a spread compression. It's a horrible environment for the agency REITs. We owned none of them. Fast forward to this year, with the Fed now starting to change, starting to lower interest rates, we think that improves book value, increases yield on the portfolio, and if we do go into recession, agency REITs have historically been a hiding place because there's no credit risk, right? It's all government-backed assets. And so they become a kind of a safe haven. So we actually have 7% of the portfolio in agency REITs today. versus 0 for the first 3 years we're investing in the strategy. And then finally, residential credit. It's kind of a hodgepodge of things, but these are typically if you have jumbo or non-conforming loans or fix and flip loans, residential mortgages that don't fit within the GSEs. They actually own the whole loans, or they might be a mortgage servicer. So they actually send your monthly mortgage statement, take your check, you get paid 25 basis points to service that, and you have a mortgage servicing right that has a value there. So, and those MSRs typically do bad if interest rates fall, and do well if interest rates rise. So you can put all of these different kinds of investments together that move in different ways, based on what's going on with the economy and the interest rates. So it's a pretty interesting industry to kind of build a portfolio around and move tactically within it.